we've seen private equity in India pretty much over the last 20 odd years. One could argue that private equity in India only really kind of took off in the early 2000 era, post the kind of dot-com bust. And since then, we've seen obviously highs and lows. Some things have worked on the exits and the returns perspective. Some things clearly haven't. We've had, I think, again, highs and lows across, be it on the regulation side, being with the entrepreneurs, and how I think businesses have kind of grown. So I think the question that I wanted to start off with is, in your own opinion, A, what has worked for PE in India, what works, and two, what doesn't work?
See, I can tell you from my experience, I've been doing this since 1993, so this is my 21st year of doing it. And I've been quite successful in terms of the investment we've done, primarily because what we have tried to do is to back entrepreneurs of passion, drive, hunger, who have integrity. So when I look back, if in India, more than backing a business or a company, you back entrepreneur. And if you get the entrepreneur right, by and large, even through ups and downs of the business, you would get it right. The other thing in India which is peculiar, the classical private equity theory is that a private company is cheaper than a public company because of the liquidity discount. But in India, between some private equity players and most investment bankers, what most people end up doing is buying an egg for the price of a chicken. And then if the egg hatches and becomes a full chicken, maybe you get your money back. But if something happens along the way, you end up losing a pile of money. So that becomes, to my mind, a big challenge. So between, whether you, first and foremost, you have to buy an egg for the price of an egg, make sure it's a good egg, then at the end of it, you make a return. And if you see the Indian private equity market over the last 10 years, it is littered with cases where people have either bought, bad eggs or overpaid for an egg. That is what I would sum up. But otherwise, I still think you find entrepreneurs in India of rare ability, rare passion, tremendous integrity, where they treat you as partners, they treat you fairly. And I think it's also incumbent on private equity people to treat them as partners, And by and large in Carlyle, the last 10 years I've been, and partly because of my background in terms of running companies, I by and large try not to give my opinion on everything under the sun. So we give our entrepreneurs very, very wide latitude, try to agree on what is important for us, and try and give them enormous freedom in terms of performing that. And that seems to have worked by and large.
Sanjay?
So I would concur with Shankar here. I think private equity model, at least from Chris Capital's perspective, and we've had a little bit of a hybrid approach between public pipes as well as minority growth investing. I would say what's really worked for us is it's a combination of three or four things. I think getting the entrepreneur right. That is a very paramount piece of the diligence that we do. But also getting the business right. I think over time, what we've really figured is if we can develop expertise in a few sectors. I think if you look back, a lot of the money in India has been made in 3 or 4 sectors, right? IT, consumer, pharma, healthcare, financial services. I would say these 4 sectors have constituted more than 85 to 90% of all the return made in private equity in India. Manufacturing and infra has been like ours. So I think these 4 sectors, we sort of developed a sector approach and knowledge tended to accumulate over time. And that experience really held us in good regard. And then I would say obviously valuation and how you work with the entrepreneur, remaining 2 and 3 parts to this whole pie, which has really worked for us.
I know that this question has been asked now in the last 3 or 4 years several times, and it's probably something that a lot of people reflect upon. I think if you just to sort of try to see from our history, me and my partner have invested since 2000, and this is our 7th fund, the current fund. We raised 4 funds at Westbridge. We co-founded Sequoia Capital in India, which so inclusive all of that. We've invested in close to 90 companies, and we've literally invested in venture growth, later growth companies as well as public markets. And honestly, it'd be hard to say that any one particular strategy works. It'd be hard to say that the venture really works, or the growth really works, or the public market really works. It keeps shifting from time to time. That's one thing. And the second thing is that that many structures in the industry are not set right for that stage. Let me give you an example. If you want to be an early stage investor in India, I think probably the right fund size is maybe $100 million. And even that is sort of, on the tech side, that's probably a little bit more than what you need. So, making sure that your fund construct is right, making sure that you keep your bar very high, making sure your entrepreneur is the one, as these two gentlemen pointed out, is the guy who sort of, passes all the tests that you have. But most importantly, that you're in the market that's going to give you a great opportunity in future. I think most money in India, in my view, has been made in markets which were going to be great, or over time they were going to be large and were ready for formation of very interesting large cap companies. It's just that you have to recognize them 5 or 7 years ahead. And what that means is that you have to have the ability to hold the company for a long period of time. So the final point I'd make is that companies where we've seen like fabulous return, 40s, 50s IRR or 20x's, and we've seen a few like that, the holding period has to be long, because when the model is about to be discovered, at that point of time, there is too much money being thrown out of that company. So these are some initial thoughts that I'd start with.
I would believe that the statistical data points to really reach a conclusion of whether what works and what doesn't work is not adequate. Because if you were to look at the depth of the private equity market in India, generally most deals are, or most statistically the number of deals have happened in the last 5, 6, 7 years. The extent of deals which happened earlier was largely in a market which was under-penetrated, relatively unaddressed. You could get sweeter deals. It can be argued that the best deals came your way. And so the stress which is visible today, somewhat, is really because of what we are seeing in the last 5, 6 years. That said, I believe that one of the fundamental challenges with private equity has been a lack of belief and a focus by most managers towards exits. Whether we like it or not, the fact is that we are more an investment-led model than an investment come exit-led model. So there is a lot of energy being devoted in terms of actually making investments, in terms of actually structuring things right, in terms of having an initial conversation whether I can exit or not. But holistically examining a transaction, whether I will truly be able to exit this company or not, is something which I believe rarely happens. And the manifestation is therefore visible across private equity funds. It's not confined to one or the other end. Perhaps we are in the same boat. That said, I would like to believe that most strategies in India should work from a private equity standpoint. Of course, there are nuances in each one of them. There are certain basic hygiene factors, such as the entrepreneur is very, very critical. The business is very important. Both factors being extremely heavy. But the approach, the focus, the kind of deals, the stage, I think if you pick right, it should work. Absolutely.
Kachin, any thoughts on that? Raghuveer?
I'm not from the private equity industry, so I think it would be maybe presumptuous of me to analyze and add some more to what has gone right and what has gone wrong. Clearly, the industry is large, and fair amount has come in the last 5 or 6 years. But in my last 5 or 6 years, which is my second stint here in India, and looking after the balance sheet that we created for RFL, I actually got a chance to interact with several mid-sized businesses in India, pan-India. And I think through this, I felt that there is a huge segment of businesses which are not early stage, which are not large and established, but which are young established, if I can say that. And when I talk to some of these, borrowers, and I'm giving the borrower view here, I think access to capital is the single biggest bottleneck for all these people, right? And these are people who have a track record, who've executed, shown that they can execute a business, know their business inside out. I think everybody here would agree that if somebody's created a 500 crore, 1,000 crore business in a market like India, mean, we had the morning session on the political this thing. I think, he's proven that he can run a business. Yet accessing growth capital, anything other than traditional means of financing, which may be a bank lending or a project finance, is a serious challenge. But the ticket sizes there are probably 50 to 100 crores in terms of requirements, or 100 to 150 crores. And I think that falls below the radar of most PE investments. When I look at some of the numbers over the last few years, you can see that the smaller ticket sizes have increased. I think the deals on the smaller ticket sizes have increased. But by and large, I think the threshold of maybe a 30 or a 40 or a $50 million translates into a 300 odd crore investment, which I think in Indian standards is still a very large company. It's probably a 2,000 crore or a larger company. And I think that leaves very little deals to choose from. And probably from there come all the issues with respect to valuations and all that. But if you look a shade below that and work with a lower ticket size, there are just a huge number of eligible borrowers, businesses that need capital, that can be given the capital. So for me, I think, ticket sizes, and not necessarily just early stage or less than $5 million, the ticket sizes of about 100 crores, give and take 25 crores or so, is seriously untapped as an opportunity. Just yesterday, I was with, we were at an infrastructure company, and this is a very specialized infrastructure company. They looked twice at taking PE in the company, but shied away thinking, we don't really know how this is going to work out. So there was that hesitation. This is 4 technocrats who've created the company, but desperately need the next 50 to 100 crores to take the business to the next level. So, that's been my experience.
Just adding to what, or taking off on what Panchan was saying, what we've been seeing, like 20 years back, to access capital and to access money, people would tend to go always to the capital markets or for private debt. Private equity is taken off in India over the last 20 years or so. So there has been access to another form of capital itself. And just following on from the example you were talking about, we've had some of our clients who work with portfolio companies, 4 guys have got together, run a business. They brought in private equity investment with a ticket size of 100 to 150 crores. Enterprise value says 600, 650 crores post money. Now, that in India is really what is early stage private equity, early stage venture capital. And from what you were saying also, when that investment happens, the whole thought process behind the exit hasn't really come into play. 5 years back, pre-Lehman, IPOs were the preferred exit route. Now, if you're talking about a company where a private equity player is picking up, say, a 25-30% stake at a 150 crore ticket size, post money 650, 5 years down the road, what is going to be the enterprise value of the company? It's going to be 1,000, 1,200 crores if it's really performed well. And if you're talking that kind of an enterprise value, to be able to get a listing in today's market, it's at best a mid-cap listing. You're not going to get much liquidity from that. So I think what you need to do here is saying whether this is the right model or not, you have to tailor your horses for courses. The different private equity players in India, the players who do the early stage very well and the exits through the secondaries and the trades. They're the bigger players in India with the bigger funds who do a bigger ticket size, 300 crores plus, 500 crores, 600 crores. And we have people in India who have done that successfully over the last 2-3 years, done controlled transactions in India, and tried to bring in professional management and turn a business around. So it's like the panel has been saying, I mean, there's no right model for India, there's no wrong model for India. I think there's a right model for a GP and a wrong model for a specific GP.
Thank you. So if I have to take off from what Shankar and Sanjay said, obviously the first step of an investment is finding the right egg, and there are obviously 2 elements there. Obviously picking the right entrepreneur and picking the right sector or the business. Obviously from a top-down perspective, I think everyone talks about consumption theme and infrastructure services as the 2 broad themes. But as we all aware, PE is not about macro but about the micro. So from a micro perspective, what are some of these sectors and segments, if you want to call it that you believe are most kind of exciting in India now? And then 2, once you kind of identified a business which you like from a sectoral perspective, what do you think are the characteristics of the entrepreneur that you would want to kind of back in India?
Yeah, just before I said what Kanchan was saying, see, the thing is there are a lot of people who want money in India. Then the question comes, who do you as a GP want to give money? A lot of people want money, you don't want to give them money. The second point is, I think 95% of companies in India haven't figured out that you should take money when you get it, not when you need it. Because when you need it, most people don't want to give it to you, you know. And then the problem comes is they meet 20 bankers, one banker gives them outlandish valuation, and the guy keeps hoping that someday he's going to get it. And if you see, most people who have come into grief in the cycle, people who have been stuck up on a lot of these things. Most entrepreneurs in sectors, you know, they do a deal with a good partner and build a business, generally tend, you know, to thrive. You know, that becomes very, very important. Now in Carlyle, I'll tell you broadly two themes what we do. I still think if you took the world as a whole, you know, in the next few years, in most of the OECD countries, large corporations have to give a better product or service to their customer at a better price year after year. So they need productivity gains. So you'll see in India broadly what I call as outsourcing themes. And it's not just IT or IT-enabled services. It could be pharma, it could be contract manufacturing, it could be textiles or whatever. You'll see a lot of the cases, not on a labor arbitrage basis, but where companies are able to take a process and do it better here. You know, those kind of companies will thrive. So that becomes a theme. And such companies, Carlyle with its network of relationships, investee companies, we can help them. So it is attractive for us. We do it. And we have been very, very successful in doing that with some of our recent investments in terms of putting them in front of the right guys, helping them in business development, etc. The second is, when this happens in a country, you have some kind of multiplicative effect on the local GDP. Because you have a young populace, you have disposable income growing, propensity to spend higher, savings higher, etc. So there are a lot of businesses that would flourish, you know, domestic consumer. You know, we invested in a dairy company which is very successful because there is inherent demand for a good product. Domestic healthcare, you know, domestic pharmaceuticals, domestic media and entertainment. So there are a lot of these businesses that would tend well. You know, I have personally thought a lot, you know, see, why is it that a guy who say sits in the hot sun outside breaking stones, he makes so little money compared to the investment banker who just tries doing deals with phones. So same way, companies, there tend to be businesses, certain businesses where it seems that there is an inherent entry barrier. Once you establish yourself, you continue getting earnings, etc. So eventually you end up, you know, identifying industries like that. And within industries, you know, companies tend to be like human beings, because at the end of the day, if in a SAT or GMAT test someone keeps getting 500 in a practice test, he'll never get 800. So in real life, toads never become princesses. So if you invest in a company that has got a track record of losing money for a few years, and you hope a miraculous transformation will happen, the probability that will happen is very, very low. So at the end of the day, if you took an overall approach, identified the few industries, then looked at a track record, and then went and met the promoters and see if the guy's got drive, hunger, integrity, generally you do well. So if I look back in 21 years, we've done a lot of deals. And in the 90s, when I started doing in 93, it was very, very easy to do deals. You know, we bought Hathaway Cable, we got control for almost nothing. A year later, you know, someone came and gave us 30 or 35 times the valuation to take a 25% stake. Those kind of deals that I think would happen. What you see today are deals where companies grow steadily with a high degree of probability. At the end of the day, it is a risk return what you're looking at. So, you know, at the end of the day, if you're sure that there is a high degree of probability, the guy would grow at 20, 25, 30%, it is fine. Most projections you see, and I'm sure all of them will agree, are companies that have had bad 2-3 years, and then their profits double every year for the next 3 or 5 years. It never happens. So as long as you're able to distinguish, I guess you will do well investing in India.
Sanjay, obviously the Chris Capital has developed some phenomenal expertise from a sectoral perspective, so it would be great to get your views on the sectoral side.
No, see, what I would add to this is, you know, if you take a step back. Like if you're a GP, if you're an LP looking at India and you're asking, you know, why aren't there more exits out of India, and what's been the real issue, right? Where is the chain broken down from finding the right entrepreneur, finding the right sector, getting an exit done? Where is the chain not working? And I think what's happened is it's fallen through the cracks in how you constructed the portfolio, right? The three or four, and I know I'm stepping into the macro again, but that does constitute, macro does constitute a significant portion of overall return, because we've always said that we'll back a theme and then we've made multiple investments. If you think about financial services, we were first in the private sector bank, so Axis Bank, Centurion, bunch, we made 4 or 5 banks, including Yes Bank. We talk about NBFCs, we got into Mahindra Finance, Shriram Transport, some of them were home runs. So we've IT services, we've done multiple deals along those themes. So I just feel that there are 3 or 4 sectors that have constituted bulk of the returns. The challenge has been the composition within the GP's portfolios of those 4 sectors have been, I think, between 15 to 25%. A lot of it has been the wide other, which includes manufacturing, infrastructure, real estate, power, and a lot of our microfinance, a lot of other sub-segments that haven't really worked out. Whereas what's worked in our favor, we've had our share of infra and other problems as well. But by and large, what's really worked in our favor is that these 4 have constituted something like 65-70%. Now, having said that, these things don't stay static, right? So every time as you look out, the future is going to be different from what the past was, and there'll be other sectors and other themes that comes in. So how do you build those sector expertise for those areas going forward will be the critical aspects. So if you take any, you could say financial services has been a great area, but microfinance and gold hasn't been. Whereas NBFCs, consumer finance, private sector banks have been the shining examples within that. So there have been sort of those micro pockets, if you will, but it comes through understanding, leading these companies over a long period of time, and then you get into the micro. I think your ability to spot the micro is much better if you've focused your energies around a certain trend or a sector. And the same team stability also plays into that. In many cases, the GB teams have not been stable. I know for a few of us here, the teams have been pretty stable. I would say that if you had the same team looking at it for 10 plus years, there's a lot of knowledge that accumulates and that can help you identify the right entrepreneur, the right business opportunity. So that would be my perspective.
Any other thoughts from the panel? I would talk about what doesn't work. That's an easy one. Our view always has been that industrials is a very difficult space to operate in India. Principally 2 or 3 reasons. One is there is a very high degree of cyclicality in industrials as opposed to services companies. Second, the regulatory overhang which plagues the industrial sector is just too much in India. The red tapeism, the approvals, the acts like Factories Act, the Compensation Act, and so on. It just weighs the whole sector down. It just doesn't allow these companies to move forward. And lastly, I like to believe that at a very fundamental level, when you expand capacity in industrial, of course, this is a bit of generalization, but when you expand capacity in industrial, you get locked into certain capabilities based on the assets that you put on the ground. And I think the world is evolving so fast, cost structures are dropping so massively, deflation is being exported around the world, you lose cost competitiveness really, really quickly. Perhaps, therefore, in industrials, what has only worked in my mind is export-led businesses. Because to some extent, they benefited from the fact that we got a weakening currency on a trend basis, and your competitiveness has been kept right there. But domestic manufacturing is tough. Now, these are generalizations, but I would say that in general, again, from a private equity standpoint, industrials are more tougher to invest in as opposed to services companies. Now, looking at services, I would tend to concur with what Sanjay said. If you have a very, very strong industrial understanding, or a sectoral understanding, it allows you to spot opportunities better. That's also the theme that we follow in Abbott Pragma. So, I would concur with that. But otherwise, the opportunity in the services side is bigger. Industrials are not so exciting.
If I look back at what we have done, I think the place where we've certainly made money is the area where there's a large consumer market, and consumer market defined broadly. It could be a product like a tile, it could be a product like a personal product like a cream, or it could be a service like a pathology service, or it could be medicines like a pharma company, or it could be even bank and financial services that are focused on consumer. So the focus on consumer in the context of Indian market is a big plus for us whenever we look at an opportunity. And the reason for that is that Indian environment has two things. One, it's in all of these sectors that I mentioned and many more consumer sectors, there are no organized players yet, or there are first signs of organized players yet. So there is a large number of small businesses, mom and pop services, or smaller businesses regionally which are serving the consumer needs. And second, there is a high degree of lack of trust in India in consumers' mind about the service or product they're buying. So generally, if you look back at our families, generally whenever you go buy something, the general instinct your grandma or your dad will give you is that these guys must be fooling you. So we found over time we've profited significantly from investing in companies that are becoming the market leader in any consumer area that used to be served by an organized market and is now going to be served by an organized branded player. Now this player then grows on the basis of two different growth drivers. One is the market itself is growing. Let's say healthcare, the market is growing at 15% per annum. And then the largest player take Dr. Lal PathLabs has 3 or 4% market share. So they're going to grow from 3 or 4 to 10 or 15 over the next 10 or 15 years. And so they have twin drivers. So when the market is growing at 15, they can grow at 25, provided they do things right. So I wouldn't be able to tell you what doesn't work, but I'll tell you what has worked for us is this broad theme.
I think that's a very interesting point that you brought up, Kanchal. Right? Just maybe if you can kind of add to that. Obviously, financing in India can take multiple forms, as you rightly said. Equity, debt can, quasi equity, quasi debt, whatever you want to call it, structured credit, structured equity, mezzanine, project finance. What type of situations are you seeing now evolve over, at least from a business model perspective, which is being attractive for these sort of kind of investment options? Is this necessarily happening in lender of last resort type of situations, or are you seeing a broader base for appetite of non-growth equity led type capital, if you want to kind of call it that loosely?
Yeah, so I think in terms of end users or the purpose of financing, it varies. You get the entire spectrum. You get the lender of last resort kind of financing, which is debt financing, which cannot be done through traditional banking channels. So that's that's a given. But you also see a lot of situations where it is essentially growth capital that is required. But there is either a hesitation to dilute, there is, or just uncertainty in terms of how this whole PE thing is going to work out. But I think there's the whole gamut of financing requirements that we see. From the point of view of the investing company, actually, I think a very interesting profile that's coming out. And this is a conversation I had, in New York with somebody, and this is somebody who had invested in the infrastructure story in India, and obviously, right now they're not very happy with this, but he was stuck. And I was just saying to them, I said, one of the things that I think has probably got missed out, or that needs more discussion, especially in the offshore markets, is the true private entrepreneurship story, right? So we talk about the political inaction and the bureaucracy and everything that has happened. But I think in spite of all that, in the last 10 years, private entrepreneurship has grown. It doesn't matter whether reforms are there or not. The private entrepreneur who started, say, 10 or 15 years ago, is running 1,000 crore business. Started from nothing, is the second generation in there. A big change that we've seen is, is the things like credit bureaus and all that have come into the country, that actually help you understand what is the payment behavior, track record, execution capability of the promoter, and how has that behavior been over the last 10 years. And that becomes a huge input, because when you're giving money at the mezzanine level or at the holding company level, you're relying heavily on those funds being used judiciously and that capital to come back to you. So it becomes equity-like risk. But I think there is a structural change, big time structural change in how the markets were, say, in the 90s to what the opportunity is today. And therefore the ability to go in and look at a variety of things. You may look at real assets as collateral, you may look at listed equity, unlisted equity, returns that are a mix of an ongoing low return and a redemption premium, or a premium linked to a certain event, or a premium linked to an exit event. All of those options are there, and I think the need for this kind of financing is huge. The opportunity is tremendous. Also for somebody who's willing to sort of dig the heels and get into the details and get their hands dirty and understand the credit, because I think one of the things we also hear in this sector is that there is lack of transparency. There are blurred lines between promoters' own funds and the company funds. But I think a lot of that is also changing. It's definitely more professionalized, and I think the PE industry has done its part in bringing corporate governance. It obviously has some way to go, but there's a definite positive change.
Just to add to what Kanchan is saying, especially over the last couple of years, we've seen more and more structured debt and structured product and mezz debt transactions happening. And I'd say there have been 2 or 3 drivers for this. One is, yes, the early stage companies which feel that they're still too early in the life cycle to bring in private equity. That's one. Second is the companies who don't have the ability to dilute that much more because they've already gotten private equity. They're looking to give an exit to their existing private equity, while at the same time they're looking to take their business of the company to the next level. So if you have a private equity guy already sitting in there at 40-45%, which is the case in many of the early stage transactions where promoters or entrepreneurs have brought in money, and a lot of money, maybe more than what they needed at that point of time, and given out too much equity. So when they're coming to the next stage, they don't have the equity to give out any more without losing control. And the third is, especially they've had, through their life cycle, they've gone through the experience of being with traditional PE, done 1 or 2 rounds with them. Now want to take a step back, give them an exit, take the company to the next level without diluting, and use the structured debt to maybe 4 or 5 years down the road, either do an IPO because they've reached scale, or do a private at a valuation which is properly attractive to them. And we've seen that over the last couple of years, especially in and around structured NCD transactions which have been happening. A lot of them are not just for the company's own financing growth needs, but just to give exit to existing private equity. A lot of the returns are linked to performance. You're giving a partial exit to an existing private equity guy. If you're saying the balance exit will happen over 3 to 4 years, depending on the IRR percentage or the share price at that point of time, you take an upside on your structured product.
Rajiv, I think an interesting point which people are now seem to be raising is around the importance or the possibility to kind of do control transactions. So from your experience, both from a portfolio management and from a exit perspective, do you believe control is important, or is influence of being able to influence the investment, being able to influence the entrepreneur more kind of relevant? I think the corollary to that is, are influence and kind of control interchangeable at all, or no? And if influence is kind of really important, how do you even initiate it and how do you kind of sustain it over the period that you hold the investment?
The answer to whether control is important in a particular transaction really depends on the kind of company that you're getting into. From our standpoint, we run a small cap buyout strategy. Our typical targets are 30-40 crore revenue firms which are profitable. Entrepreneur have perhaps lost interest in terms of, or the willingness or the capability to figure out how they are going to grow the company. In such situations, we have always found that you're better off taking control. I think more importantly, what we also consider while acquiring control is the fact that our exit position is going to be superior. It is our belief that if you are getting into a small company, we are not going to be able to find good enough exit options other than a sale of the business. And doing these negotiations later with entrepreneurs that I am a minority, you try and sell your majority, never works. So let's enable ourselves first. So perhaps it's an imperative of the investor, which is us, to acquire control. Then comes the question of engagement. Now, I would like to distinguish between classical control transactions, as we tend to define it here, versus buyouts. Right? Control transactions being where we are buying 50, 60, 70% equity ownership, entrepreneurs, management teams continue to remain invested in the business, and you are essentially helping, supporting, engaging with them. Whereas buyout being 100% buyout, and you are bringing about significant transformation. I think let me highlight a couple of areas where these two models differ. Let's take capital allocation decisions. When you have entrepreneurs, what we have found is that being disciplined about capital allocation is extremely tough. Entrepreneurs by nature are comfortable with risk. They tend to be opportunistic. After taking in the capital, they identify another opportunity, they would want to very seriously and very quickly allocate capital in that area, which may not be your underwriting investment case. You may not have studied the opportunity, you may not have underwritten it. it makes you feel uncomfortable about the whole thing. You don't have that problem when you have a buyout with a professional management team, because they very clearly understand that certain investment case has been written in, this is how the capital is going to go in, there is a supporting case behind it, no issues at all. On the other hand, if you were to look at expense management, we will find that professional managers in a buyout situation somehow don't seem to get their heads around running a company frugally, which comes very naturally to entrepreneurs. So the discussion with entrepreneurs is never about expense management, cost management, and things like that. But when you have professional managers running a business who either been brought in or inducted subsequently, you just can't seem to get your head around what expense management is all about. They come from large corporate backgrounds. They are not so disciplined about running a company frugally. I like to call it flying first class all the time, and that's what plagues a control or a buyout transaction. So I think there is a distinction between the two. From an engagement standpoint, therefore, what becomes critical for us is, depending on the transaction type, the entrepreneur type, the management type, we have to calibrate our engagement appropriately. You've got to put the pedal on certain things and let go on others. But invariably, we have found that from our standpoint, especially when looking at small companies, a focus on strategic issues and keeping them center stage is very, very critical. Small companies, they have a tendency to drift away from their core, and keeping them absolutely aligned to that can be the one common ground that you would not encounter as a problem in both areas.
Thank you so much for taking the time out for this. This was certainly very insightful and certainly very compelling insights that we got from everyone. Thank you again.